Hey everybody, it's Wayne bringing you a portfolio update for week 41 of 2023. If you guys have been following me even for a short amount of time, you know that I feature primarily two of my brokerage accounts. That's going to be M1 as well as Robinhood, both of them being taxable accounts. Now I am actively contributing to other retirement accounts. Some of them are tax deferred, some of them are Roth accounts. But for the most part, I only feature the M1 in the Robinhood with occasional updates from the other accounts. Let's go ahead and start off with the key to my success for 2023 will be consistency. And that consistency comes down to my daily cost averaging. If you guys didn't know, on a daily basis, Monday through Friday, I am contributing $125. That is without exception. And for 2024, I'm going to continue along that path as well. Now, for this year, I have been primarily focusing in on individual stocks with the exception of two ETFs. So let's go ahead and take a look here at my portfolio, which currently sits at 145,000. Now, for the week, you can see here that I'm slightly up just over 1%. For the month, I am down nearly 3.31%. I always like to look at the total holdings. This gives me a total unrealized gain, and in this situation, it's an unrealized loss of just over 4% or $6,380. So let's go ahead and take a look here at the slice that I am funding on a daily basis with that $125 each day. And that is going to be the positions within the long-term hold slice. Notice the target weight for this slice is 80%. So in reality, the quarterly dividends, the monthly dividends, and the ETF slice has really received little to no attention this past year versus the 17 positions that I'm holding within the long-term slice. I'm going to go ahead and read these off real quick. We've got O, Realty Income. We've got SCHD, UNH, AVGO, VDE, SO, Waste Management, PG, UNP, Johnson & Johnson, Visa, Texas Roadhouse, Pepsi, AbbVie, McDonald's, Caterpillar, and Lowe's. Now, within this long-term slice, only two of these 17 positions are going to be ETFs. That's going to be the fan favorite SCHD. If I click on SCHD, you can see here in this brokerage, I only own 33 positions. But it should be noted that I'm actively contributing to SCHD, not just in my taxable accounts, but also my tax deferred or my Roth IRA. VDE, which is the Vanguard Energy ETF, this is the second ETF that I have been funding. And I actually started a position just a few months ago, but already I've been able to accumulate about $2,200 worth of shares or 17.95 shares in total. And you can see my cost basis on this is $121.89. The current share price is $125. So we're doing pretty good with that ETF. But truth be told, I'm glad that these prices continue to go down because I really want to take advantage of true daily cost averaging. So that's what's going down here in the M1 account. Let's go ahead and give you a look now at what's happening in the Robinhood account. Okay, switching over to Robinhood, you can see the current value of this account is $391,000. Now for the week, I am down just under 0.5%, which is about $1,500. A little bit more significant of a drop though in the past month. I am down 1.84% or $7,319. But I am always a glass half full guy, and that glass half full has to do with my year-to-date return of just under 25% or $76,000. Now, as you guys know, I use Robinhood primarily to sell covered calls, in addition to holding quality stocks that I sell covered calls against. Let's go ahead and take a look here at the account breakdown by clicking on the investing tab. It's always important to note, in the sense of full transparency, that $391,000 breaks down to be just under $350,000 in stocks and options, and I do hold about $41,000 in brokerage cash. Now, I gotta tell you, the last couple of months, one of the downsides to selling cash secured puts has been because I am actively selling puts pretty much on a daily basis. None of my brokerage cash has been able to earn interest. As you guys know, I'm a big fan of Robinhood, and I am a Robinhood Gold member, and they are currently paying 4.99% APY. But I really haven't been able to take advantage of that because all of my money, for the most part, has been tied up with selling cash secured puts. So of recent, I have been pushing more cash into my wife's Robinhood taxable account because she is not selling the amount of cash secured puts that I am. And so that brokerage cash in her account is able to accrue more interest. And so I think what I'll do here in a couple of weeks, get you guys an update on how much interest we have been able to earn with our money, primarily in that account. All right. Can't look at Robinhood without giving you guys a rundown at the top 5 positions. Take a look here. Microsoft, I currently own 201 shares. Now, my average cost for each of those shares is $246.75. So Microsoft, by far, with a current share price of over $327, is my big winner with an unrealized total return of over $16,000. Celsius, you guys know that this has been a favorite of mine. I actively sell covered calls as well as cash secured puts. And for my 100 shares, take a look here. My average cost per is $76. So you can see here, I have a huge return on my Celsius position. Apple's also doing rather well with my 200 shares. Meta, in which I also own 100 shares, allowing me to sell covered calls, is doing rather well. And then Costco rounds out the top 5 best performing stocks. You know, Costco is a position that I sold out of last year, and I was able to buy 100 shares of IWM. I almost immediately regretted it because Costco just continues to dominate regardless of what's happening in the market. And so Costco is a position that I am daily cost averaging in the Robinhood platform, and I'm currently contributing $20 per day. Let's go ahead and give you a look at the top 5 losers in my portfolio. Tesla in the last couple of months has also repeated its poor performance for the year. So I am currently down just under 8,000 on the 300 shares that I actively own. Great thing about Tesla, though, is I have been able to make up that deficit with selling covered calls as well as cash secured puts. I've said this before in other videos that I talk about my options. Hands down, Tesla is going to be the biggest winner for me when it comes to selling cash secured puts in 2023. Boy, if we look at Traeger, Target, UPS, and CVS, I gotta tell you, Traeger is not a surprise. I have been holding this miserable and heavy bag for a long time. I'm really at the point, though, where I am going to average down. They have recently, once again, flirted with 52-week lows. I know what you're thinking, Wayne. Why don't you just go ahead and cut this bad boy loose and be done with it? I really don't have a reason to sell out of this position because I do expect it to go back up. The problem is I don't expect that rebound to happen anytime soon. So this is certainly a long-term play. The old Wayne would have said, I'm in the red, let me go ahead and cut my losses. The new Wayne is trying to have a more analytical approach, right? Does it make sense to average down versus just cut my losses? Now, out of these top 5, I guess, biggest losers, the one that's really a bummer to me is UPS. You can see here that I own 101 shares. Now, my average cost was $180.94, and just a couple of months ago, I was able to get this up over the 100 share benchmark so I could sell covered calls. And no sooner did I buy those remaining 30 plus shares to get me to 100, the share price of UPS has just dwindled. And I am so mad that I didn't just continue to daily cost average. I was so obsessed with being able to sell covered calls. And guess what? I'm not selling covered calls against UPS because I refuse to sell below my cost basis. And so with that, UPS is really doing nothing for me other than paying out my dividends, which, by the way, are rather good. But I really hope that UPS and Target and even CVS rebounds in the foreseeable future. I'm not as optimistic, though, when it comes to CVS. This is a position that even though I own 100 shares, there's plenty of room for me to average down. I'm not going to do that. I just have not been impressed with my holdings, but you guys will have to remain tuned in to see what I do in the long run. And with that, let's go ahead and close out on what I can expect to receive this month in passive income. One of the things that I love about Track Your Dividends, which I pay $100 on an annual basis, is it gives me a great calendar of all of the dividend payments I can expect to receive for the upcoming month. You can see here today is the 15th, and the past couple of weeks I've received $1.38 on this date, $16 on this date, $83 on this day. Last week I received $26 on that Tuesday. The Friday to close out last week I got about $151. And then upcoming dividends, you can see here next week I can expect to receive about $290 on Monday, another 33 the following day, and then closing out October with about $76. Now, one thing I want to point out about Track Your Dividends, it is not going to be 100% accurate. In fact, because I am daily cost averaging those 17 positions within the long-term slice within M1, sometimes Track Your Dividends will calculate those current share prices to update what the dividend will be for this month, and that's not realistic given that X dividend could be prior to me beefing up that position. But there you have it, a quick look at all of the activity for both of my primarily portfolios. Can you believe that we are almost done with 2023? I'm rather excited that I have been able to stick to my plan of daily cost averaging. And the only thing I can say is you guys have not seen anything yet, so stay tuned. I hope you're having a fantastic week, and we'll see you on the next one.